Hey Bowtie Nation, Joseph Hogue here, and you know we love us some monthly dividend stocks here on the channel, but sometimes they're like that toxic friend everyone has. You know what I'm talking about. The friend that drops by to give you his used recliner, but then borrows $200 that you will never see again. Monthly stocks pay out some of the highest dividends out there, like 11% on shares of Cross Timbers Royalty, ticker CRT, but then regularly cut their dividend as the stock price goes nowhere but down. CRT has cut its payout more than 20 times in the last 5 years. And the shares are down 51% in the last year alone. That's why I'm digging into my two favorite resources for monthly dividends, the REIT Watch and BDC Insights, to help you find those dividend payers that won't let you down. I'll walk you through each report, show you how to analyze monthly dividend stocks, and then highlight the 5 safest payers in each. First up, $59 billion Public Storage, ticker PSA, cashing in on our love for impulse shopping and cluttered garages. The company operates over 3,300 properties and stores the treasured possessions of 2 million customers to pay a 3.5% dividend yield. Now that cash yield might not ring your bell. We will see higher yields in this list, even into the double digits with the BDCs later, but understand there is a trade-off here. With that dividend safety, you expect to collect lower yields, but also that the stock price is going to move higher versus those higher yield stocks that might actually lose money. For example, beyond that 3.5% dividend, shares of Public Storage are up 20% this year. Against other storage REITs, Public Storage has the lowest FFO payout ratio at just 59%, which means it can grow the dividend faster or just keep more back for growth. It is also using the lowest amount of leverage here at just 2.5 times debt to EBITDA. In fact, compared to peers in the space, Public Storage may be a little overly conservative. With 4.5% growth in those funds from operations, the lower dividend yield, and strong fundamentals, I expect we'll see strong dividend growth coming from PSA. We're just getting started in our list of monthly dividend stocks, but if you didn't catch that first episode in the series, be sure to look for the link in the description. In it, I showed you how to find these 2 free reports and the great information you're going to find, along with the 10 highest paying dividend stocks, so make sure you check out that video next. The yield and the fun factor is higher here, with Vici Properties, ticker VICI, with a 5% dividend yield and 93 properties across gaming and experiences, including some of the biggest names in Vegas, like Caesars and the Venetian. The company owns properties in 26 states and all triple net leases, which means the tenants pay all the costs. Vici just collects the rent. The company has grown its dividend payout by 7.9% a year, well above the 2.2% average dividend growth among REITs, and it should have no problem keeping up that growth with these fundamentals. Vici pays out just 61% of its funds from operations as dividends and carries a lower debt burden than competitor GLPI. FFO growth of 3.7% and strong travel trends this year should help support that stock price and the cash yield. I'll show you what measures I'm looking at to find those safest dividends in real estate stocks next, but just like in that first video, just as important is that we pull stocks from different property types as well. It's an important point that most investors miss, because if we're just picking stocks with, let's say, the lowest payout ratios, for example, then we might have all of our investments in lodging properties, here with an average 12% payout ratio, and nothing in healthcare or telecom, which tend to have higher payout ratios. But not only does that leave us dangerously exposed to just one or a few property types, and if the economy turned against them, but it ignores the fact that some groups just have higher or lower payout ratios because of their fundamentals. Lodging and resort property cash flows are less stable versus telecom, so naturally those companies are going to be more conservative in their payout. But it doesn't necessarily mean that they're safer or that telecom property stocks are riskier. So you always want to compare the ratios within a property type as well as across the stocks and by a few stocks across the group. For our safety measures here, I'm going to be looking at the FFO payout ratio first. Now that's the percentage of the company's funds from operations, so FFO, so that core measure of cash generation for real estate, the percentage of that going to meet the dividend. The lower the better here, because it means the company has more available for growth or can see the FFO drop without putting the dividend in danger. I'll also be comparing the stocks on their debt to EBITDA ratios, how much debt they owe relative to their earnings. Again here, lower is better for dividend safety, as those with the highest leverage might find it hard to service that debt if their earnings do fall. In hotels and leisure, $24 billion Host Hotels, ticker HST, pays a 4.6% dividend, with properties across 81 hotels at Marriott, Hyatt, Four Seasons, and Hilton. All the kinds of upgrade places I'm too cheap to stay at, but someone is. With 13% annualized growth in funds from operations and 21% dividend growth, The company is outperforming its peers in all the important metrics. The company's payout ratio of 27% isn't the lowest in the group, but it's still safe, and it does have one of the lowest debt to EBITDA ratios, so there's no problem with liquidity here. I would like to see that higher FFO growth, but again, travel demand was especially strong over the summer, so I think we're going to see some good numbers from Host for the second and third quarters here and beyond. Quite a bit smaller here is $3 billion LXP Industrial, ticker LXP, with its 5% dividend yield and a pure play on warehouse distribution. With 117 properties and 58 million square feet across 15 states, mostly in the eastern half of the country. Tenants include some of the largest and most financially secure companies, including Amazon, Nissan, and Walmart, with 94% of the properties leased and a 2.7% annual rent increases in the contracts. LXP isn't the lowest for payout ratio in its industrial REITs group, but at 42%, it's got plenty of remaining funds to grow revenue or just grow the dividend. It's also about half as levered as some of these, with a debt ratio of just 4 times, and FFO growth is expected to come in at a strong 5.6% this year. Now, industrial property has been one of the standouts over the past 5 years, benefiting from that rise of e-commerce and warehousing. I'm highlighting some of the safest dividend stocks in today's video, but another way I've been getting that monthly cash flow lately is through Arrived Homes. The platform packages rental real estate as LLCs, so you're going to get a direct investment for less than $100, and without the massive down payment or management headaches you get from rental real estate. You're going to earn dividends on that rental income, and Arrived has recently transitioned to monthly dividend payments, so you're earning from 3 to 8% annualized and getting that cash flow every month, along with the price appreciation when the property is sold. This is one of my favorite investments right now, but I know you've got a lot of questions. I know I did before I started investing, so I'm going to leave a link in the description to the platform. One thing, the homes available for investment sell out fast, so make sure you click through and get on that notification list. Alexandria Real Estate, ticker ARE, and its 4.4% dividend are something different in the healthcare REIT space. The company owns 350 properties, almost exclusively life science laboratories leased out to research and testing, but it also has a venture unit investing in the industry, so that growth kicker that you don't see with most other REITs. Now let's get into those BDCs with even higher dividend yields, but first, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now on to our safest dividends in BDCs, business development corporations, using the free Raymond James Weekly Insight Report. Again, I have no relationship with either of these two reports. I get no commissions if you use them, but there is a lot of information here and I want you to have the best resources. Now, BDCs offer some of the highest dividends in monthly payers, so you definitely want to know how to analyze them. First up, Gladstone Investment, ticker GAIN, is one of the lowest yields in BDCs at 7.5%, but still well above what we saw with those REITs. Against that lower yield, we've seen the stock price rise 66% over the last decade for an additional 5% return a year on top of that dividend yield, while most of the higher yield stocks go nowhere at all. And how GAIN produces that higher return is through its business model. Gladstone's target investment of 25% equity position and 75% debt versus most other BDCs that aim for less than 10% equity in their businesses they work with. That higher equity position means higher risk for Gladstone, but also higher returns on those investments. Because of how that BDC report is laid out, it's easier to put all this side by side in a table. So that's what I did with these 12 companies with positive yield spreads. Remember, that's the difference between what the company collects on its loans, that average portfolio yield, and what it pays out in the dividend yield. So all of these are collecting more than they pay out. Now, I first ranked by that yield spread and highlighted the top 5 in yellow. Then I ranked for these other 2 measures, the debt to equity and the efficiency ratios, and highlighted the top 5 in each. For our safest dividends in these BDCs, I'm going to pick from the ones with the best overall, not just the highest dividend or the highest yield spread. And you can see Gladstone pays one of the lowest total dividends on the list, but has the highest yield spread and one of the lowest leverage ratios. It's a strong pick if you want those stock returns along with your dividend yield, but maybe not the best for pure cash flow. You'll get a feel for what I'm looking for in these safe BDC dividends as we talk through each stock, but again, I'm starting here with the average yield spread above that total dividend. Now you find this by starting with the weighted average yield, which remember, again, that's the interest rate the company collects on its portfolio of loans, then minus the total dividend yield. We used this measure in our previous video and probably see in other lists because it is the most important, really the core measure of how well a BDC is covering its dividend and producing that interest income. A BDC getting a higher average yield than it pays out as a dividend can grow that share price as well as sustain its payment. One thing you're going to notice immediately, though, that looking at the three measures together with the top 5 safest highlighted in yellow for each, is that the highest yielding stocks are not necessarily the safest. Sure, you might be able to collect that 14% dividend on shares of Trinity Capital, but the yield spread is just 1.9%. The company is heavily indebted and not operating at the best efficiency. On the other hand, much smaller 8.4% yielding Main Street is one of the highest yield spreads, the lowest debt ratios, and the best efficiency ratios of the group. A higher yield, but still in the Gladstone family of companies, is Gladstone Capital with its 8.8% dividend. Gladstone reports loans across 12 industries, which actually is not as diversified as most, so maybe a little riskier here among other BDCs. But it is hard to ignore these stats for safety. The company has the third highest yield spread along with its second lowest debt, though it isn't operating quite as efficiently as the rest on our list. The dividend growth has been outstanding though, up 135% over the past 5 years, and overall, the company has produced a 9% annual return. Quite a bit smaller here at $3 billion market cap, but getting us into those double-digit yields is Hercules Capital, ticker HTGC, with its 10.2% dividend. Hercules focuses on providing loans to high-growth companies in the innovation economy with life sciences, technology, and internet, and has produced some Herculean results. Sorry, I couldn't resist, but investment income has grown at a 12% annualized rate, with total assets growing almost as fast. Hercules doesn't have the highest yield spread, but it's still positive, which is way better than most BDCs, and it's one of the most efficiently run companies. We've still got 2 of the safest monthly payers next, and we're talking safety in this video, but there is nothing wrong with going after those higher dividend yields as well. A great portfolio, the one that's going to help you live off your dividends, has that balance, so don't forget to check out the previous video with the 10 highest paying monthly dividend stocks here, or linked in the description. Main Street Capital, ticker MAIN, is a special case here and almost didn't make the list with its 2% dividend, which really doesn't even qualify as a dividend stock in my book. The problem here is that the shares have jumped so fast, up 22% in the last year, the dividend just hasn't kept up. Again, as a business development corporation, Main Street specializes in loans and equity investments to mid-sized businesses. The company had 182 portfolio investments as of the first quarter, with the largest representing just 3% of its total fair value, so a hit to any of these investments isn't going to hurt the shares that much. But against that lower yield, Main Street has the highest yield spread along with the best efficiency and cost controls, and one of the lowest debt ratios. That tells me we could see strong dividend growth and probably equally strong price returns in the future. One of my favorite BDCs, though you probably won't see much for price return, is Horizon Technology Finance, ticker HRZN, with its 12% dividend yield. Horizon makes secured loans to venture and private equity-backed companies in the life sciences and technology industries, a $26 billion addressable market. That venture capital market has taken a hit over these last few years, especially in the Silicon Valley set, but there is no better market for growth for a BDC like Horizon. The company offers one of the highest dividend yields with a great spread for safety, though the leverage is quite a bit higher than I'd like to see. Still, it's hard to pass up that 12% dividend yield. Get monthly cash flow and the upside appreciation in rental real estate on the Arrived Homes platform. Don't wait though, make sure you get on that notice list with the link in the description, or click on the video to the right for the first in our series, the 10 highest paying monthly dividend stocks. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.